Have you invested in potato salad today? Thousands of people have. Find out why on today's Where the Money Is. Hey everybody, I'm Mark Reith here with the incredibly handsome Michael Finarelli, and welcome to another edition of Where the Money Is. It's Tuesday, so it's all consumer goods, all show. I'm excited. How about you?
I'm excited. I'm always excited for Tuesdays.
I love me a good Tuesday.
God,
you know?
Good Tuesday.
Better than Monday. You don't have people running around yelling hump day for the Wednesdays. It's not so bad, and we get to chat about all these great consumer goods companies.
That's right.
It ain't too shabby. All right, let's jump right in then with our first headline. Macau casino revenue falls, VIPs blamed, investors rejoice, by Mohammed Cohen over on Forbes. Now, this headline has a lot going on with it.
Yep.
Let's break it down, shall we?
Sure.
So Macau casino revenue fell in June by about 3.7% year over year.
Right.
That's big news because it's the first time their revenue has declined year over year since June 2009.
Right, correct.
What happened here?
A lot of people are blaming, well, the VIP market, of course, World Cup, betting kind of made a dent into that. But, I believe anyone who's panicking on this is likely losing it on big, longer-term potential down the road.
Right. I agree with that. Like you said, so the World Cup, I've been seeing that a lot in the research I did. The World Cup, people are starting to bet on that. They're not so focused on going to the tables, throwing down the chips.
Right.
The interesting part of this headline, though, and you touched on it, is the VIPs blamed. And that's been a concern for Macau for a while now. There's just been this longstanding belief that, well, so much of Macau's revenue comes from these huge Chinese, Asian VIPs, these big whales, if
Large
you will.
bettors, right.
Right. And now that's starting to decline. What does that mean for Macau? Oh God, what are we going to do without the whales?
Well, I don't necessarily know that we need to save the whales here. So,
Nice.
there's been a shift that's going on towards the mass market, to be honest with you, which seems to be a little bit more lucrative. I think it's actually higher margin than the VIP bettors, to be completely honest with you. I think Las Vegas Sands, who has a huge position in Macau, I want to say like 75% of their cash flows derive from the mass market. So this is a shift that's continuing. It's not that big of I don't want to say that it's not a big problem, but it's not life-threatening for these operators over there, that the VIPs aren't necessarily there, starting to die off. And there's good reason for that, too. I mean, partly the government's trying to clamp down on corruption and things of that sort. So. Right,
I agree. All right, so let's focus on this last section. Investors rejoice. You touched on it. Which casinos out there look like they're going to be A-OK if Macau comes crashing down, the VIPs stop buying into it? What happens? Who do you like?
I like Las Vegas Sands. Right. Years ago, Sheldon Adelson made an investment, kind of a visionary investment in the Cotai Strip, and now Las Vegas Sands dominates the Cotai, to be completely honest with you. And they've got a great position, of course, in Macau, which gives them a great position in neighboring Asian countries, too, as well. They're a proven operator. They generate a lot of free cash flow, generate high returns on capital, so it's an attractive business. And going back to the point that they're a proven operator, as other countries like Japan, many people are speculating that Japan's going to open their doors to gambling pretty soon. This puts companies like Las Vegas Sands in kind of like a front-runner position to win licenses for those markets.
I absolutely agree. And I actually also like Melco Crown. I didn't know too much about it before doing the research for this segment. I was surprised to find 2/3 of their revenue comes from mass market. Yeah. They're not dependent on VIPs to begin with. They already have 2 casinos in Macau. They've got a new one coming next year, and it's got a great spot. It's right next to the land bridge, the Lotus Bridge that they're building. And that it's right next to the light rail that they're also building. Right. You're not going to see whales on the bridge, on the light rail, but you are going to see a lot of the mass market coming across from the mainland. Melco's going to be the first thing they see. They already love the mass market anyway. Right. I like Melco. I like Vegas Sands. Let's continue, shall we? The next headline is from Jeff Reeves, who says 5 great brands that I think are bad investments. Now, out of these 5, 3 of them fall into consumer goods. I figured we could touch on those 3, see if we agree with Jeff.
Right.
The first one was Coke, and he said Coca-Cola, it's a great brand, obviously, one of the strongest brands in the world, but it's a bad investment because of the slowdown in soda drinkers that we're seeing, this 9-year slowdown, a gradual decline in the number of people who are A-OK with artificial sweeteners and all the sugary, not healthy for you drinks. Right. What do you think about what he's saying?
I actually agree with his sentiments here on one respect. Not so much that the brand is going to be tarnished by slowdown in carbonated beverages. I mean, they still have a strong suit overseas, to be completely honest with you. My concern is more with the valuation of the company. Trading at 22 times trailing earnings per share, what the current stock price or PE ratio is, only yielding 2.9%. I think there's better opportunities out there for Coca-Cola, aside from Coca-Cola.
I absolutely agree. All right, his next brand was Amazon. His argument is that, again, great brand. We all love shopping at Amazon, nice and cheap, quick shipping.
Yep.
But investors are starting to get a little pissed off that there are no profits. There's nothing to show for it just yet. What are your thoughts?
Yeah, I think the brand is amazing. There's no question about it. I mean, they just have a sticky kind of atmosphere, environment, like an ecosystem per se, in which pretty much all their services are geared towards getting people to get on the site, buy more goods. It's a retailer at heart, and everything that they do is basically geared around this. Even the Fire Phone, to be completely honest with you, is. So I really like the brand. And a lot of people, it's an old argument that, profits are eventually going to come. But I think you have to have a longer term vision with Amazon. I still think that they're in an investment phase. They're building out their investments. They're still trying to build out their ecosystem and increase consumer loyalty, especially among Amazon Prime members, which there's a lot of potential to generate, to increase Prime memberships. So I think you have to have a longer term picture, and you've got to look beyond earnings. Obviously, the PE ratio, I think its trailing PE was something like 500, some
stratospheric
figure, which obviously doesn't make sense. If you look at it on a free cash flow perspective, it looks a lot more reasonable. And I have to go back to having a long term focus here.
I like it. All right, last but certainly not least, Whole Foods. It's declined 32% this year. PE ratio is looking a little pricey, and of course, more competition than ever before. Honestly, this is the one that I actually kind of agree with.
Okay.
Great brand. Whole Foods, it's a first mover in this healthy foods market that we're just seeing blow up so much over the last couple of years.
Right.
But the problem is it's blown up so much that now everyone wants in. Right. Sprouts wants in, Kroger wants in. Everyone's trying to take a bite out of Whole Foods' share.
That's true.
I like the company, I like their expansion plans, but I don't like the amount of competition, the lower priced competition entering the market right now. What do you think?
Anytime you take an operator that has, a great product or service, they generate, fat margins, high returns on capital. If they continue to sustain that over time, it's like an open entrance for competitors to come rushing in, right? But I got to be honest with you, Mark. I'm going to take the opposite position, because when you go to those other grocery stores, when you go to a Walmart or to a Kroger or a Safeway, or even to the other natural goods grocery stores as well, the direct rivals to Whole Foods, who are growing and who are competing, it's not the same experience. And I think the comment was that 22 times earnings for a staples retailer. I wouldn't call Whole Foods a staples retailer. There's a lot more to the actual experience, the quality of the food. I'm actually bullish on Whole Foods market, and I think it's an attractive entry point at this point.
And agree to disagree. All right, our final headline comes to us from our very own Nikki Friedman. Why Starbucks' new Physio handcrafted soda move is bigger than you think. Now, at the end of June, Starbucks began selling these handcrafted sodas. They're all natural, no added corn syrup, no preservatives, none of that flavoring.
Right.
They come in root beer, ginger ale, and lemon ale. Have you had one yet?
I have not.
I haven't yet either. I'm not a Starbucks. I'm not a coffee guy to begin with.
I am a coffee guy.
You are a coffee guy. So are you buying into Starbucks soda?
I think it's a great idea. Why not? Basically, it expands additional day parts at the restaurants, so this gives people a reason to come back in the afternoons. Everyone loves to get their coffee fix in the morning. But, perhaps, the soda drinkers might want to come back in the afternoon and try a soda. So it increases foot traffic, additional sales, more cross-selling opportunities. What's not to like about it?
Here's what's not to like about it. People know Starbucks for coffee. People go to Starbucks for coffee. They go in the morning, and like you said, Starbucks is trying very hard to be this third place. You got home, you got work. Where else do you go? You go to Starbucks. No, you don't. You go to Starbucks in the morning so you're not walking in dreary-eyed. You get your coffee. I have never stepped foot in a Starbucks past 11 a.m.
Okay.
Honestly, there's no reason for me to. They're trying to make reasons for me with their beer, with their soda, with their later day parts, as you said. But I haven't heard my friends say, "Oh, let's go to Starbucks tonight, guys. Forget the bars. Let's head over to S-Bucks." Yeah, I don't know. I'm not buying into it just yet.
Well, to be completely honest, to be fair though, that's not exactly the demographic I think they're trying to steal from. They're not going to try and take away from the bar crowd.
25-year-old kids going out every night.
Right. Come on. That's a little bit of an unfair comparison.
Okay.
Starbucks is more about the experience too and the atmosphere. It's not just about the coffee. And I mean, let's take a look at how they've expanded their portfolio. Teavana, Evolution Fresh, and so forth. These are growing brands. They're becoming strong, popular brands. So it's becoming more than coffee. And I think there's a lot more opportunity out there for the company.
We just have to keep on disagreeing, Michael.
We do.
Ugh, what are you going to do? All right, let's move on to today's Stock in Focus. Now, it's midway through the year. It's been an interesting one for a lot of companies, and none more interesting than Lululemon. Which, my gosh, first of all, let's take a step back even before this year. Let's look at 2013. Okay. You had the see-through pants scandal.
Sure.
You had CEO Christine Day backing out. You had founder Chip Wilson just opening his mouth and never shutting it. And all of that sent shares down. Now, this year alone, 2014, shares are still down 30%.
Yeah.
Brutal.
Brutal.
What's going on with Lululemon?
You know, you named a lot of the points right there. I mean, so you have, right now going forward, you still have Chip Wilson, right? So he's no longer CEO, chairman, I believe, but, you know, he still is the largest shareholder. And so you're still going to hear from him time to time. There's a risk factor there involved, you know? You know, is he going to do something crazy? Is he going to try to influence the board? Is he going to try to get his own way? He is a large shareholder, so in a way, his interests are also tied to other shareholders, or at least hopefully so, but you know,
I don't know. These stories I'm hearing about him, he's ready to start a proxy fight. He brought in Goldman Sachs. I don't know. It seems like he's not going down without a fight. Like you said, you're still going to hear from Chip Wilson, which can't be good for Lululemon.
Right. No, it can't. And aside from Mr. Wilson, I mean, you also have the inventory issues, and it goes beyond the Cher Luan pants scandal and all that sort of stuff. If you actually look at their inventory turnover ratio, it's actually been declining. You know, decelerating over the past couple of years, since 2011, I think. So that's something that you might want to keep your eye on for investors. And then, of course, increased competition. You know, you talk about Athleta, Gap's Athleta, for instance. I think they've got like 73 stores right now, so they're growing pretty quick. And it seems like that their MO is they're opening stores pretty much right next to Lululemon.
It's the Burger King model.
It is.
Yeah.
You know, and of course they're offering sharper discounts. So they're trying to gain some market share from that manner as well. You know, the question is Lululemon still, is it a strong enough brand, and does it resonate enough with its its loyal customer base, especially that higher demographic target?
That's the question. It almost seems like Whole Foods all over again. Lululemon was a first mover in this market. Like you said, a very strong brand, very loyal customers. A lot of people love it. But man, so much competition entering this market. Like you touched on Gap, Athleta, they have so much going for them. Lots more promotions. The products are, on average, 7% cheaper than over at Lululemon. You have services there that you don't have at Lululemon, like a hemming service. So if you're a shorter lady looking for your yoga pants, you have more options over there. It just seems, on top of all of the problems they had last year, on top of the threat of Chip Wilson doing something crazy again this year, on top of the fact that their inventory was up 23% year over year, like you mentioned, and earnings were down 59%.
Ouch.
Ouch. Big ouch. I don't know. Lululemon, it scares me a little too much right now. For right now, I think I'm staying away. What are you doing?
You know, if investing were easy, Mark, we'd all be millionaires. You know, there's a lot of risk, there's a lot of uncertainty. On the plus side, there is a plus side, believe it or not. I do like the optionality that they have in their business going forward. You know, so we know in the past, at least, that they've had a very strong brand name. If they can continue that, and if they can build that out amongst additional demographics, expand their customer base like they've been essentially been doing with other products that are targeting children, targeting men, and things of that sort. You know, we kind of have to wait and see if this is going to continue to gain traction and how much traction it will actually gain. But it could very be a great strategy. It could be a great way that they could really build out their brand exponentially. And that's really the big question. You know, we were talking before we started filming here about their revenue per square foot, you know, and Lululemon generates some ridiculous figure in revenue per square foot. I believe it's north of $1,800.
Jeez.
You know, it's approaching the realm of Tiffany and Apple, to be completely honest with you. But
so just to interrupt you for a second, so that brings up an interesting point. So Tiffany, Apple, highest sales per square feet in the business. Now you got Lululemon. So clearly it's almost looking at itself not quite as a luxury brand, but as a higher end, an exclusive brand. Are people going to buy into that when they're having so many problems with like see-through pants or pilling on their pants? Are people just going to say, it's almost, again, back to Whole Foods. You can go to Whole Foods with their great brand, but they're higher prices.
Right.
Or you can go to Kroger with pretty much the same thing. You can go to Gap Athleta, pretty much the same thing. Are people going to keep on buying into Lululemon's brand strength?
So the company is definitely trying to turn things around, and that's going to be the question mark. And it's a great point. So is the company going to be able to improve their inventory issues, improve product quality, and regain, the name that they once, or the stature, I guess, that they once had? So that's the big if.
Right.
If they do, then it could be big gains from this point.
Fair. Last question. You mentioned Lululemon breaking out into different demographics, including men. Is that where you buy your yoga pants?
No, last time I checked, I actually don't do yoga.
No.
I don't wear yoga pants.
You're missing out, man.
I am missing out. Yeah. I really do need to.
Yeah, great for you.
But the funny thing is, though, obviously, I'm an oddball. I'm not their target demographic.
Okay.
So, I mean, just because I don't buy their products doesn't mean that no other man will.
Listen, I'm hearing a lot of the same excuses here. Starbucks, I'm not their target demographic. You're not Lululemon's target demographic. We're not giving the people any information. My gosh, this is just brutal. All right, let's move on to our educational segment called Learn Something. It's a very original name. Over the last couple of weeks, we've been hearing news about Bed Bath & Beyond starting its share buyback. It's a $2 billion share buyback program. Mike, let's start with the basics first and foremost, the very basics.
Yep.
What is a buyback?
Sure.
And why do companies do it?
Okay. So a buyback is basically when a company repurchases its own stock, basically. Okay. And the effect is that it reduces the overall float. And this is actually a benefit for shareholders because, although the pie, if you think about earnings for the company's earnings and its ownership base is a pie, so the earnings pie doesn't necessarily change, but everyone's relative piece of the pie, their portion gets a little bit bigger. So, more of the company's earnings, its actual profit, are attributed to your position, your ownership stake, which is a good thing, of course, right? So, that's essentially why companies do it. It's really an investment in itself. There's three things a company can basically do. There's three primary ways a company can allocate its capital or its shareholder money. Okay, it could reinvest back into the business, it can pay a dividend, or it can buy back shares.
Okay. Why is Bed Bath & Beyond choosing that option, not the other two options?
Well, buying back shares is a great strategy at this point for it because it's not necessarily growing like it used to in the past. It's still reinvesting into the business, but its capital expenditure its requirement isn't as large as it was in the past, right? So, it's a little bit more of a mature company. It's not building out store base. I think over the past couple of years, it's maybe added on, say, 50 stores or so. So, it's not growing extremely rapidly. It doesn't have a huge capital requirement need. So it is, keep in mind though, it is still reinvesting in itself, and it is generating very high returns on capital. So reinvesting in itself is a good idea up until the point where you need to reinvest in yourself. Why do you actually buy back shares as opposed to pay a dividend? Well, paying a dividend for shareholders can be lucrative too as well, but then you're also facing taxes too, right? So the company's going to get taxed on its net income. And then it's going to use net income, after-tax net income, to buy back or to pay a dividend, which of course is going to be taxable at the shareholder level too as well. So you have that double taxation problem. This is a much more tax-efficient strategy.
Taxes. I always forget about taxes.
Life, death, and
taxes. What are you going to do? All right. So on the announcement of this buyback, which I think was this Monday or last Monday, shares slumped. Now you would think that shareholders would actually be happy about news like this, maybe buy a couple more shares. Why are shares going down?
It's a good question. I'd be happy as a shareholder to see my portion of the pie get a little bit bigger.
Right.
To be honest, I really don't know.
Okay. Well, and on that note, shares are down 19% in the last year, in the last 12 months. Bed Bath & Beyond, like you said, it's reaching a maturation point. They're not adding new stores so much. They don't need to reinvest so much. Right. They're not ready for a dividend. They don't need the taxes. It seems like a buyback isn't a bad play for them.
No.
Does this have a chance of working? Does this have a chance of turning things around, stopping the drop, 19% drop, bringing things back up?
I don't know if I'd look at it as in the sense of how it's going to affect the stock price in the short term.
Okay.
As a long-term investor, you want to focus on how the company is adding value, how management is adding value. And a share repurchase, especially at its current price, which I think its valuation is pretty attractive right now at this point, considering, going back over the past 10 years, looking at its historical average. I really think it's a good play. I mean, the stock probably is depressed a little bit based on competition, level of competition.
Right.
Other competitors online and so forth have been eating into their sales. But again, I think this is a good move.
I like the long-term perspective you're bringing to the show today. It's nice, It's very foolish way of looking at it.
Very foolish.
Yeah, very nice. All right, let's move on to today's mailbag. Our letter comes from Lauren K. And if you want to send us an email, send it over to cg@fool.com. Lauren K. says, I loved Wendy's pretzel bun burger last year. Who didn't? Especially when they helped boost the company's sales. Now it's back. Can Wendy's recapture the magic? If not, should I bail on Wendy's? And for those of you who don't know, last year, about, I don't know, like 6 months ago or so, probably earlier than that, Wendy's released this limited time offer of a pretzel bun bacon cheeseburger and a pretzel pub chicken sandwich. People went nuts for these sandwiches. They sold 50 million sandwiches. The sandwiches alone boosted sales 3% in Q3 and Q4 for Wendy's. It seems like a no-brainer to bring it back. So to answer her questions, do you think Wendy's, is it going to see 50 million more burgers get sold this year?
I don't know if we'll see 50 million more burgers. I mean, it's an extremely popular item, and I like the idea of rolling it out, periodically for a limited time period, because it's going to, as opposed to leaving it on the menu as like as an all the time item, right? So it's going to kind of reinvigorate sales. It's going to reinvigorate foot traffic, and it's going to lead to repeat purchases during this period of time for other, there's going to be other cross-selling opportunities. So I don't know exactly what the margins are on the pretzel burger, to be honest.
Got to be low.
I would imagine they're low.
Right.
But it's also, I mean, are you going to buy a pretzel burger and not order fries and not order a soft drink, which tend to be higher margin items?
Right.
So I do like the idea. I like the idea of ushering in traffic periodically, every once and again. I don't know if I'd look at it as reinvigorating the stock, though, to be honest. There's so much competition in this space. When you look at McDonald's and you look at Burger King, who have larger scale than Wendy's, Wendy's is in a difficult position.
You're right. Wendy's it's clearly not the biggest fish in this pond, which is an extremely big pond, by the way. But I like that it's almost a trendsetter in a way. So it was the first one to bring out these pretzel bun burgers last year. Now everyone's got the pretzel bun, the artisanal bun. Everyone's doing it. I like that Wendy's took it away and people went nuts about it. And Wendy's said, all right, we're listening and we're going to bring it back. I like that they have the trendsetter. I like that they are listening to the people. I like that they're doing this. I like that, like you said, cross-selling opportunities. For an extra 30 cents, you can get this bun on any other sandwich. It's not like they're just going to keep it with these sandwiches. It's not like they're going to keep it on the menu for forever. Although this is interesting. They haven't said specifically if it's a limited time opportunity or not, or if it's going to stay on the menu. I agree with you. A limited time opportunity makes a lot of sense, cause a lot of excitement around the summertime. Sales skyrocket. Sure, they slump, but summertime is the most important time for these burger chains. I don't know. Wendy's is not the strongest play in the fast food market by a long shot. But I like that they're a trendsetter right now. I don't know. It's interesting to me.
When you think about fast food, too, in general, I mean, you look at the overall headwind from fast casual, companies like Chipotle, and basically the consumer shift towards eating healthier. So, I mean, it's a pretty significant headwind that these companies are facing. I do like the product innovations. But when I look back historically, at least at Wendy's financial performance, they generate really weak returns on equity, returns on capital. So, I mean, it's not a very profitable business model. At least hasn't been in the past. Maybe things can turn around. I guess time will tell, right?
Yeah, it's true. And to your point, the fast casual, it's just been blowing up. You look at Panera, you look at Chipotle. Is this a move by fast food companies to kind of pivot in that direction? Look at our artisanal fancy bread. Oh, so luxurious. Maybe not in reality. Maybe that's not going to work. But do you think that's, like we're talking about trends, do you think that's going to be something we start seeing fast food companies turn towards? Or is it always just going to be burgers?
No, I think to an extent, I think you've already seen it. I mean, with restaurant upgrades that we've seen from, I mean, down the street, there's a McDonald's down the street from my house that
Swanky.
looks very swanky.
Yeah.
Very, very swanky. So, I mean, they're all trying to create this level of atmosphere that you might find from other establishments, higher quality establishments. So I think you're already seeing that to an extent.
Okay.
But I don't think they're going to abandon the old burger and french fries.
How can you? It's a classic. It's an American staple. Last question. Have you had a pretzel bun burger?
I have.
You have?
I just had one about a week ago.
And?
Tasty burger.
Really?
A real tasty burger.
Worth a 3% uptick in sales, huh?
Definitely.
All right, let's wrap things up with our Tweet It section. I went on Twitter earlier today, found me some cool stuff. Let's chat about it. Our first tweet comes from money.com. Can you name the company that owns Charlie Brown? It's getting investors' attention. Michael, can you name the company that owns 80% of the rights to the Charlie Brown characters? Peanuts characters, excuse me.
No.
No one can. It's a little fund called the Iconics Brand Group. They own a whole bunch of smaller brands that you might not hear about so much, but Peanuts are one of their big ones. There is a Peanuts film coming out in 2015.
Really?
I know, just because Hollywood can't think of original things anymore. There's going to be a Peanuts film, and Iconics Brand stands to make a bit of cash off of it, not just merchandise tie-ins. You got fees to sell the rights to make the film. You have box office.
Sure.
It could be a nice little investment for Iconics at least. Maybe not for shareholders. I don't know enough about the company, quite frankly. But I found it interesting that Charlie Brown is owned by a fund.
He's making a comeback.
Don't call it a comeback. It's been here for years. All right, our next tweet comes from the Wall Street Journal. Americans are drinking less beer but more wine and spirits, according to new data. And there's the chart. You can see beer is ticking down slowly but surely, while wine and spirits is up a bit. I thought that was interesting because, I'll be frank, I'm drinking more beer than ever, Michael.
Yeah.
What did you have for the 4th of July? Were you a wine guy, a beer guy?
I was actually a beer guy this 4th of July.
It's very American.
But it is very American, very patriotic. You got to go that way on the 4th, right?
Absolutely.
But I could see the rise in wine and other beverages too as well.
Yeah?
Yeah.
I don't know. My poison's always a good tall can of Budweiser. Just true American. Speaking of the 4th of July, this is what I started the show with, and we've got to end it with something as weird as this. Today, Kickstarter project to make $10 potato salad raises $35,000 plus. Now, I know you haven't heard about this, so let me explain. A guy named Zach Danger Brown got on Kickstarter and told the people there that he wanted to make some potato salad. He's never made a potato salad before. He doesn't want to risk spending money for these ingredients. He doesn't know he's going to like it, doesn't know how it's going to turn out. Turn to Kickstarter and let the people pay for it. All he was asking for is $10. He's made $36,000 so far from over 2,000 backers. What are you people doing with your money? Invest that money in other things besides potato salad. Just ridiculous. I don't know. I don't like potato salad, quite frankly. That's
Neither do I.
Yeah, not worth $36,000. Although, to his credit, he has promised the people that he's going to throw a potato salad party for all of the backers. So, I mean, maybe I'll get in on that action.
Yeah.
Throw a dollar his way, try some hopefully tasty potato salad. Who knows?
Sure. If you
Invest smarter, people. Okay, that's it for our consumer goods filled edition of Where the Money Is. If you ever want to be involved and get your mailbag read, send us an email at cg@fool.com. For the incredibly handsome Michael Finarelli, I'm Mark Reith. Thanks for watching, and we'll see you next week.